Hi guys, welcome to the latest UK house market report. This is where we run through the latest Zoopla report, which is up to the end of September 2022 on this occasion. So before we go any further, if you could subscribe to this video, hit the like button, and of course you'll be given regular updates on all our new videos that we publish. So look, without further ado, let's head in. So look, as you can see with the report here, the current UK house price growth is still strong. We're still looking at 8.2%, and as I say, that's up to the end of September. But what it's not taken into account is any slight fluctuations that we've seen and any kind of things that have happened over the last week or two, where we've especially had some tax changes, where we've had some issues with the weak pound, and of course some rhetoric from the Bank of England and what their plan is and what they're going to do. Now, although that we've seen the house prices increased 8.2%, we're actually going to see a decrease in buying power. It's been a seller's market for years. The market has been really strong and sellers have been able to literally name their price. And we're going to go through more of this report in a bit, but typically what we've seen is 10 years worth of growth has been condensed down to 2 years in some areas. They just rocketed up in price. Now, those days have gone. We've been going all along saying that the market is strong. We don't think we're going to have some huge crash. But what we are fully aware of is we don't think we're going to have the same kind of returns that we had over the last couple of years. So as you can see here, once interest rates started to increase, mortgage rates start to increase, then you can see here we've got a negative 28% hit to buying power. So that means clients have got 28% less buying power that they could have played with before due to these higher mortgage rates. Doesn't mean the market's going to dip by that amount at all, and we're going to come to that why in a bit. But in terms of buying power, and especially first-time buyers, they're going to be the ones that are affected. This is pretty key as well. We've got, in terms of reductions, we've actually had 6% of listings have been reduced by more than 5%. However, we have to look at where those reductions are. And a lot of them are being skimmed off the top end of the market. You've got London right behind me. They were well overinflated, some of the prices in London, and they were getting those prices. But of course, if you've got something that's up for £2-3 million and you can reduce by 5%, then of course that kind of thing's been happening. So again, a lot of these have been for the higher end properties. We're not seeing some of the lower end properties have that kind of hit at all. But typically, where we're having 5% reductions, it doesn't mean, and this is where people get slightly confused, it doesn't mean the prices have dropped by 5%, because the market is judged on the sale prices, not what they are on Rightmove. It means they were just simply overinflated in the first place and they were chancing their luck. So look, let's head down to the executive summary here. The housing market is transitioning from a buyer's market or seller's market to a buyer's market, because the way mortgage rates are going, especially as people come more off their fixed rate and they have to get a new mortgage, we're seeing here that it's going to cut buying power by up to 28%. Jump in house prices from the pandemic is obviously compounding the affordability, but the jump in house prices that we've seen is going to start to stable off, which we've been saying all along. What we don't feel is going to happen, which is what a lot of people are saying, is this major crash. We just don't feel it's there, and we're going to come on to that in a bit. And like we said before, some regions, because there was this COVID need for space, some regions have seen 10 years of house price growth compressed into 2 years. So this is what's really compounding the market at the moment. New sales are holding up. At the moment, this is key. So we've got new sales are holding up here. There's no sudden drop in demand in recent weeks, but we are seeing buyer interest is weaker than a year ago. However, what I would say is let's not judge it from what it was a year ago. Let's go back 3 years pre-COVID and judge it from then, and we're still up. Because if we're judging things on a year ago, most things are going to be down, because 1 year ago it was off the charts. It was just unseasonably adjusted. It was things that wouldn't normally happen in the property market happened. So we can't judge things on what they were 12 months ago. Let's go back to a normal year and judge it, and we're actually still up. So new sales are still increasing 3 years ago. Asking price reductions are at the highest level since before the pandemic. So people are asking for money off of their Rightmove and their Zoopla listings, and they're getting them, especially as I said here, off the higher end, mainly because if people can't afford the mortgages, they can't afford to buy the property. It's as simple as that. Stamp duty changes are going to support certain regional markets and first-time buyers in southern England at a very low cost to the exchequer, as you can see here. So it's not going to have a big impact on the money that comes into the coffers on the exchequers, but it will have a good impact and strengthen that market. So look, let's have a look at the macroeconomic news. We obviously know that central banks have increased interest rates. We know that the Bank of England have got theirs at 2.25%. We're potentially looking at another one in November as well, potentially increasing to 2.75%. But what I found interesting recently is when the Chancellor announced the number of tax cuts, it wasn't actually too dramatic. The reason why things got a bit out of sync in terms of the pound was because what you've got is you've got the Chancellor doing one thing, putting money back into people's pockets, when you've got the Bank of England doing another, which is taking money from people's pockets. So the moment you've got the government and the central bank pulling away from each other, it causes a nightmare for the markets. It's just the unknown. And what happens is the pound got dramatically weak. It at one point went to 1.04 to the dollar overnight. It then sprung back, then come back again slightly, and now it's getting a bit stronger and back on an even kill. But what it did mean is a lot of people at the time, there was a lot of overseas investors who actually snapped up a lot of property and got their money into pounds in that particular week. So it actually slightly strengthened the amount of inquiries that we had. But what we've seen is that the Bank of England, one member of the Bank of England committee came out and said that they need to do something drastic, and everyone thought that meant we're going to put up an emergency rate hike, and that caused a big scare in the mortgage market, and a lot of mortgages were actually withdrawn. But actually what they did do is they started buying back bonds, and of course the mortgage market has calmed down a bit since. And when you look at it, the actual interest rate that we've got is still pretty low, 2.25%. Okay, it's not as low as what we've seen over the years in terms of the historic lows, 0.25 and 0.5%. But overall, in the last sort of 40 years, 2.25% is still extremely low rates, and extremely low rates for mortgages as well. Of course, we're also seeing the fact that energy prices are still up there, but we are seeing oil pegged back slightly, so the cost of oil has come back down, although OPEC has recently announced it's going to cut production, which is probably going to push barrels of oil up above that $100 mark again. So we might see some energy prices, especially at the petrol tanks, start to increase again. However, we do have certain energy price caps in place, and they are starting to say now it's not going to cost the government as much as they first anticipated, which again is going to start to strengthen things. But again, as I said here, the UK government, it responded with tax cuts and energy price caps. But when you've got one policy going against the other policy, that's when it creates that bit of nightmare in the market. So look, let's have a look at what the mortgage rates are going to do. Now, most loans are fixed at the moment. A lot of people, and we talk about mortgages, typically 7 in 10 buyers use a mortgage. So 70% of property purchases use a mortgage. It's not going to affect a number of people. Most people are probably still within their 2 or 5 year fixed. We'll probably start seeing more of this impact over the next 12 to 18 months. As people come out of their fixed term, we'll start to see more and more people having to renegotiate their mortgage at a higher rate. And that's when things will potentially become a little bit dicey. We don't think anything major, but as I say, it will become a little bit dicey in the market. And people are now, especially first-time buyers, have got to put down larger deposits or allocate more of their income to mortgages. Now, what people do is they will obviously adjust their budgets. People will have to go out less, spend less. There has been a lot of stress testing in the market over the years, and we read in the last month's Zoopla report that it was up to 7% stress test. So that's strong, but the reality is that we are going to see some dicey issues in the mortgage market over the next sort of 12 to 18 months or so. And as we can see here, the pandemic really boosted property prices. Everyone wanted this initial need for space. That's why if you look at houses, how much they increased in comparison to flats. Now, there is a bit of a caveat to that. Many people say, well, I shouldn't be buying flats in the city centre then. No, this is flats everywhere. And that's the problem, is if we look at city centres flats, you will probably see a similar kind of pathway to houses. But this is flats everywhere. So flats in the suburbs, along with houses in the suburbs, houses would win hands down. They would have far more demand and far more price increase than a flat in the suburb would, because they wanted need for space. But what we're seeing now is the city centre flats over the past, especially the last sort of 6 to 8 months, they've come back with a vengeance, because people want to be behind me now. They want to be, in the city centre, as we always say, in the hub of things. If people have been, literally locked up because of COVID, people want to be out, especially the younger demographic. And we are seeing all of our properties are rented. Every single one we've got, and we've got a large number of rental properties, they're all rented, every single one. And even when one comes back on, we had a development complete around this time last year, so we had 50 or 60 units literally come back on, and all of them were either re-rented for another 12 months or let within a week. So they literally re-let within a week. So a tenant got out, then we did a clean, and then we had tenants back in. So the rental market is unbelievably strong at the moment, especially in the city centre. As I mentioned before, we've got the pandemic. We had 10 years of growth in some areas, really condensed down to that 2 years. We had sort of 27 to 30% jumps in certain areas of the pandemic, and typically we see 2, 3, 4% a year. We've really had a bumper 10 years, but what we're really interested in is where it's going to go. So what do I think? Do I think there's going to be this major crash, which everyone is talking about? You have a lot of people, the more or the closer we get to peaking property prices, you're going to have more and more people say that there's going to be a crash, because the reality is property prices can't keep going up, just like stock markets can't keep going up. There has to be a correction. So what they do is they hedge their bets. They say there's going to be a correction, and of course, inevitably they're right, there is a correction, but is there going to be a crash? There's a difference between a correction and a crash. So a crash for me is anything above that 10% mark. The moment you start to hit 10% to 15% plus, that deems a crash. A correction may be 2 or 3, maybe even up to 5% of a correction. For me, that's not an issue, because most people buying now, typically, if they do a short-term let, especially in a city centre, we can make them 10% in 12 months. So even if they have a fall, a correction, a crash, whatever you want to call it, up to 10%, we're actually not too worried about that, because we can make that back in income within 12 months anyway. And I don't think it's going to fall by 10%. The moment we start to get to 15 to 18 to 20%, of course, then it's worth keeping your hands in your pockets, not getting your checkbook out and waiting. But we don't think it's going to be anywhere near that, because stress tests have been done, because the reality is cost of materials are high, so the developers need to sell it. There's not much manoeuvrability in terms of those prices. So we think that especially new houses and new properties and new apartments are going to still command that kind of level that we've been looking at. So do I think there's going to be a correction? Yes, I think over the next sort of 12 to 18 months, we may see certain areas tail off 2 to 3%. But overall, I think that we're still going to have a good end to the year. And this is reviewed in this report here, which we'll come down to. I still think we're going to have a good end to the year. I think we'll probably see a static year next year overall, but I still think there's good pockets of certain areas that can still do 3 to 4% increase, because we are still at low rates, 2.25%, even if it went up to 2.75% in November. Those rates are still extremely low in comparison to what we've seen over the last 40 years. So as we start to come down, you can see that other factors that are helping, stamp duty changes are delivering benefits as well. And the Chancellor come out and said that they're going to increase the brackets of the stamp duty. Some clients are saving several £1,000s on that. And of course, that also has an impact on buy-to-let and investors as well. There's still great savings to be had there. And of course, because we're seeing overseas clients now getting more into the market, we're probably up until the beginning of this year, 50-50 in terms of our UK client base to our overseas. We're now predominantly seeing 60 to 65% overseas, because the pound's weak and people from wherever, whether we get United Arab Emirates, whether it's the States, they're actually getting great gains at the moment. So the southeast of England is going to continue to with high stamp duty cost. We know that it's because of the price of the property market. But overall, we actually don't feel, as we said, that we're not going to see this dramatic decrease. We're not going to see this crash. You've got here in the report, right now we don't see any big variations in price adjustments by region or property type. You've got, again, it continues to say the adjustments are expected to be as market transitions from one where demand greatly exceeded supply, but these are not precursors for big price falls, but they simply indicate the rate of price growth will slow more rapidly in Q4 and into 2023. So as we say, we just don't see there being this big crash that everyone's talking about. Again, we can always be corrected if we suddenly see interest rates peak 5, 6, 7% plus, totally different story. But at the moment, we just don't feel that they're going to get there. The Bank of England had a great chance to do an emergency rate hike. They chose not to. So the next one, I believe, is November. So as I say, what we see here is a slight tail off in demand, a slight tail off in terms of the peak prices for especially high-end London, but what we do see is still a good solid end to the year, and 2023 would just simply be that little bit flatter. Now, as we get to the markets and the actual regional areas, still pretty much the same, guys. We've still got your Nottinghams, your Leeds, your Birminghams, Manchester, Bournemouth, Liverpool, etc. It's still the northern cities, really the Midlands and up, that are taking care of those top 10. What do we suggest people do if they want to invest? The reality is that people who have got money sitting there, inflation just eating away at it, people have still got great opportunities to invest in the property market. If you look at a property market over any 10-year period, whether you bought just before the crash in 2007, 2008, and you held it 10 years, the reality is you would have made money. So as long as you're looking at property medium to long term, and you've got the regular income coming in, you will make good money. I have no doubt about it. So take it over a 10-year period. If you're going to say to me that you're going to look to buy a property 1 year and sell the next, no. My advice is don't buy property. There's too many expenses on properties, the stamp duty, legal fees, mortgage fees, and you may buy at a 2007 price and sell at a 2008 price. It's not where you want to be. But if you're holding medium to longer term, I've got no doubt that the property market is still solid and the best place to be, because you're getting income every year. So regardless of how the property market is doing, people still need to live, so they rent. So city centres are the best place for that. We can still do short-term lets where we can return 10, 12%, which is what we're doing now. So you've got that regular income coming in. If you're making 10% a year, your house is paid off in 10 years. So your house is literally getting a free apartment on that. And of course, don't forget, it's the leveraging that you can do, which you can't do. So if you've got 50,000 and you invest in the stock market, well, that's it. You're making money on 50,000. Whereas if you've got 50,000 and you're investing in the property market, you're actually making money on your 200,000. So, okay, yes, there's mortgage costs with that, but you're still making the growth on the 200,000. So that's 150,000, which is actually not your money, but you're still making money on it. So we're still confident about the property market. Yes, there's going to be a slight tweak. Let's see the way rates are going to go. And what I would say is it's probably advisable that we start to look at things maybe 18 months, 2 years down the line. You can start to get some off-plan prices, getting some good price cuts with what we've seen in some below market value properties, and start thinking about the mortgage in a couple of years' time when hopefully rates will slightly dissipate and we start to get some cheaper mortgages. Well, I hope that helps. As I say, hit that subscribe button, hit the like button, and you'll get all our latest videos. And take care. Have a good rest of the week.